Understanding Profitability Ratios, a Comprehensive Guide. Introduction to Profitability Ratios. Profitability ratios are essential financial metrics used to evaluate a company's ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity. These ratios serve as indicators of a company's financial health and operational efficiency, ultimately helping investors, analysts, and management make informed decisions. It is essential to use profitability ratios as comparative tools rather than relying on them in isolation, as they offer a more nuanced understanding of a company's performance over time. Significance of profitability ratios. Profitability ratios can provide valuable insights into how effectively a company is managed and its capacity to generate profits. Investors use these ratios to gauge potential investment quality. Higher ratios typically indicate better performance, with companies exhibiting strengths such as the ability to charge premium prices for their products, maintain lower operating costs, or both. These ratios are most insightful when compared to industry peers, historical performance, or average metrics within the sector. Key takeaways. Assess a company's ability to generate profits from operations, revenue, assets, and equity. Indicate how efficiently a company converts revenue into profit. Serve as comparisons against historical performance or industry standards. Categories of profitability ratios. Profitability ratios are categorized into two primary types: margin ratios and return ratios. 1. Margin ratios. These ratios provide insights into a company's capacity to convert sales into profits. Some notable margin ratios include gross margin, operating margin, pre-tax margin, net profit margin, cash flow margin. 2. Return ratios. These metrics evaluate a company's ability to generate returns for its shareholders relative to their investments. Some common return ratios include return on assets, ROA. Return on equity, ROE. Return on invested capital, ROIC. Detailed breakdown of key profitability ratios. Margin ratios. 1. Gross margin. Gross margin is calculated by subtracting the cost of goods sold, COGS, from total revenue and then dividing by total revenue. This ratio gives insight into the effectiveness of a company in producing and selling its goods. A high gross margin indicates pricing power and operational efficiency. 2. Operating margin. Operating margin is determined by taking operating income, revenue minus COGS and operating expenses, and dividing it by total revenue. This ratio highlights how well a company manages its overall operations. A company with a superior operating margin is typically better equipped to handle fixed costs and navigate economic downturns. 3. Pre-tax margin. The pre-tax margin considers all expenses except for taxes, allowing analysts to see how well a company operates before tax liabilities affect profitability. A higher pre-tax margin suggests effective cost management. 4. Net profit margin. Net profit margin reflects the percentage of revenue that remains as profit after accounting for all costs, interest, and taxes. It is often considered a strong indicator of a company's overall financial health. A declining net profit margin over time could suggest increasing costs or declining prices. 5. Cash flow margin. Cash flow margin measures how effectively a company converts its revenue into cash flow from operating activities. This ratio provides insight into the liquidity position and helps assess whether a company can fund operations and pay debts. Return ratios. 1. Return on assets, ROA. ROA is calculated by dividing net income by total assets. This metric assesses how efficiently a company utilizes its assets to generate profit. A higher ROA indicates better asset management. 2. Return on equity, ROE. ROE measures net income as a percentage of shareholders' equity. Investors particularly value ROE because it reflects how effectively their equity is being used to generate returns. A consistently high ROE may indicate strong management performance. 3. Return on invested capital, ROIC. ROIC evaluates a company's efficiency at allocating capital towards profitable investments. It is calculated by dividing after-tax operating income by total invested capital. Investors often look for a ROIC that exceeds the company's weighted average cost of capital, WACC, signaling value creation. Importance of profitability ratios. Profitability ratios are critical for assessing a company's ability to generate regular profits and manage investments effectively. These insights directly reflect management's capability and the company's financial standing. The commonly utilized profitability metrics, gross margin, operating margin, and net profit margin, are integral for understanding a company's profitability trajectory. Conclusion. Profitability ratios serve as a crucial tool for companies and investors alike to assess various dimensions of financial health and performance. By categorizing these ratios into margin ratios and return ratios, stakeholders can develop a comprehensive understanding of a company's capability to earn profits relative to its operational efficiency and investment strategy. Whether you're managing a business or evaluating potential investments, an in-depth understanding of profitability ratios is vital for making informed financial decisions.